use the short-term rental loophole because you can do it part-time and don't have to work full-time in real estate or use questionable strategies. Even 100% bonus depreciation does not return. This remains the number one tax strategy for high-income earners in 2025, which is, I'll show you. So my investment philosophy is buy long distance. Since I live in California, very high cost living. The numbers doesn't work because the house is so expensive here in California and the rent are not enough to cover. So most risk investors, they had to go out of state. When you go out of state, you buy long distance, buy remote, buy turnkey, new construction, cash flow properties in high growth markets mainly in the South and Southeast, because you buy an entry level home, single family home to fourplex, ideally use 30-year fixed rate mortgage with the Fannie Mae lending guideline, the best lending guidelines available to you, and then put down 20 to 25% down payment. That is what you do. Finance, leverage with a loan, and then invest over time, get the tax benefits, get the rental income increases, get the great 30-year fixed rate mortgage to leverage your purchase, thereby give you higher return, get the tax benefit, and get the tenant to pay down your debt. All right, you know what? I need to get back to, I might need to show you another PowerPoint. Do I? All right, no, we'll grow. All right, here's the easiest rule to achieve to get the max deduction. So it may or may not apply to you, but this is the first initial rule you need to learn about the path of loss limitations. So if your adjusted gross income is $100,000 or less, you may deduct up to $25,000 of rental losses against earned and portfolio income, even if you actively participate in the management of the property. So this is the easiest rule to achieve. And so therefore, if you have property manager managing your property, you spend almost no time in managing your 2 or 3 or 4 rental property portfolio. If I'm talking about, you spend very little time, which is fine. Most people do that. I do that. And many of my hundreds of students over the years, they do that. They buy out of state. They delegate the property managers, do everything for them. At the end of the day, they spend 1 hour or 2 hours per month managing the real estate portfolio, which is fine. So it is even fine, better if you make $100,000 or less adjusted gross income, and you can spend almost no time managing your property. As I stated earlier, you can deduct up to $25,000 of depreciation, past losses against your W-2 income, only if the W-2 income you earn less, $100,000 or less. No material participation hours necessary, which is a higher, stricter rule to meet in terms of how much are you involved in managing of your property. However, here's another exception to the rule. If your adjusted gross income, look, you live in California, you most likely can make $100,000. I don't want to assume, but if your AGI adjusted gross income is greater than $100,000, the law phases out any deduction at 50 cents on a dollar to each dollar incrementally over $100,000, whereby if you make between 100,000 and 150,000, there's a phase out 50 cents to each dollar to a point where when you make more than $150,000 or more, you get no deduction. Passive losses will be suspended indefinitely to the future years. Does that make sense? Let's get back to how to do a simple calculation. I mentioned the $25,000 passive losses. What do I mean by that? How do you claim up to $25,000 of passive losses if you make $100,000 or less, so you can get the whole deduction in that year, in the tax year, in the current tax year? This sample, this number comes from a sample, a real life sample of a fourplex I just skip over. Yeah. I took the liberty of take out this particular fourplex within our portfolio, for my network, this is a real property, by the way, and it's being promoted to investors as we speak. So this property in South Texas is a fourplex, brand new fourplex, 4-unit at $545,000. When you analyze a deal, when you underwrite any deal, you create a pro forma, or let the software help you create pro forma, whereby you document all the critical numbers, the purchase price. You put 25% down payment. Here's the down payment. You pay the closing costs. Here's your total out of pocket. And the rent on all 4 units is $5,400. You break it down to 4 units. The rent for each unit, I don't know, $1,200. I don't know. Monthly, then you calculate the property taxes, monthly insurance, property management fee, if that's the case. And then you get a loan, I don't know, with 30-year fixed rate loan at 25% down payment. If the loan is 6.85%, it's just a projection. Then this is your loan, and the mortgage payment is $2,678 plus your monthly debt obligations, which is right here, $833, $233, $419. These are regular traditional expenses. At the end of the day, what you look for is a positive cash flow, which is $773, which is quite attractive. You quite meet the benchmark for cash flow investor. That's how you do it. 25% down payment. That is the cash flow you talk about. $773 first year, first month cash flow, and not a bad beginning. Having said that, this is the property we could use for the tax return sample. I'm gonna share that with you. So that property is $545K, and then typically around, give or take, 20% of the land which the property is located, the land component, if it all said and done, the land is not depreciable. Land is land. So what you do is you take out whatever the percentage component of the land you reduce from the price of the property, 20% multiplied by 545K. The land component is $109,000. Since the land is not depreciable, you have to take out the land portion of it. 545 minus 109 equals 436. This is the basis for depreciation calculation. Paper loss. Paper loss is not real loss. Paper loss. If you own residential property less than 4 units, you can do a straight line depreciation, paper loss, to the tune of 27.5 years. 27.5 years divided by into 436,000. So your annual depreciation for that fourplex, if you make less than $100,000, is $15,854. So going back to the previous rule, we already discussed that. I'm not gonna go back; it's too far back. The previous rule is, if you make less than $100,000, you can deduct up to $25,000. That means this one property, this one fourplex already give you $15,854. So if you make $100,000 or less, this entire $15,854 in this 4 unit can offset against your earned income, which is in this case, your W-2 income. That means instead of having that $100,000 subject to an ordinary taxation at whatever tax bracket, a marginal tax bracket, 20 to 25%, I don't know, you'll reduce the $100,000 of AGI, just gross income, by this whopping deduction on just one fourplex, $15,000, $15,854. So $100,000 AGI, just gross income, reduced by this paper loss, equals like around $74,000 subject to the marginal tax bracket. The gap between the $100,000 subject to that initially, if you're unable to parlay this depreciation or this fourplex into the equation, you would be taxed at the marginal tax bracket at $100,000. Because I just showed you this example, your new adjusted gross income after deducting this $16,000, your new adjusted gross income subject to marginal tax bracket deduction is $74,000 instead of $100,000. So this gap of $16,000 gap that you're able to create is a tax savings. I don't have the exact amount. Let's make the argument just for simplicity purposes. There's more to it than that. Just do a simplistic calculation. This $15,000 tax savings of paper loss in this example, if you're already 25% tax bracket, which maybe 20%, if you have 100 grand, okay, single or married filing jointly, doesn't matter. This $60,000 of reduction of your adjusted gross income subject to ordinary taxation, which is the highest marginal tax bracket. Let's say 16 grand multiplied by 25% tax bracket. So let me do my calculator. Just give me a moment. So almost 16,000 multiplied by 25% tax bracket equals 4,000. This is not a precise calculation. This example, this paper loss deduction, this income you have on the rule I just shared with you, 15,854 multiplied by 25% federal marginal ordinary income tax bracket equals a savings around $4,000. Does that make sense? Extra $4,000 add on to the return of your investment at a point in time. At a point in time. So if you add on these tax savings of approximately $4,000 on top of the cash flow income you're able to make, let's look at the cash flow income. As a matter of fact, I like this example. Hear me out. I just came out with a good presentation. So this example of this fourplex, you are already getting 1% rent to value ratio. What that means is 1% of the purchase price equals your gross rent is a very good number. So your property is at $545K, 1% rent to value ratio equals $5,400. So this is a very good metric. That means this is a very good cash flow property. You have a capitalization rate 7.6%, which is above the benchmark. A cap rate like a 5% equal cash flow. This cap rate is higher than 5% cap rate. So right off the bat, I can see that the cash flow is quite high. It's higher than normal. I don't know what is your experience level. Do you really know how to calculate capitalization rate, cash on cash return, debt coverage ratio, and total return on investment? I'm not going to get into this. It takes too long for me to explain. But at the end of the day, you have a monthly net cash flow of $773. We already discussed that. Multiplied by 12 months. At the end of the first year, you have almost $10,000 of annual net cash flow. 12 months multiplied by monthly cash flow 773. Simple. Then I calculated a 5% appreciation at the end of the first year. Pretty normal. 5% multiplied by the purchase price, $545K, equals, at the end of the first year, a paper equity growth of $27,250. Does that make sense? Annual net cash flow at $92.87 plus first year appreciation at 5% projection based on my pro forma, if you will. $92.87 plus $27,250. Then this software calculate a principal reduction of $42.74. That I'm not completely sure how to calculate that. Principal reduction, I don't know, the debt pay down, there's an economic benefit associated with a debt pay down. The tenant is, at the end of the first year, is paying down your principal, essentially. The tenant going to pay all your expenses for you. That's how it is. The tenant going to make you rich. This software calculate additional $4,274 in principal reduction at the end of the first year. So you add on the annual net cash flow, which is this number, and the annual net principal reduction benefit because you're reducing the amount of the loan. There's an economic benefit associated with paying down your 30-year fixed rate loan at the end of the first year. My tax software have this amount, $42.74, which is a 5% appreciation. 5% multiplied by 12 months, $10,000 paper money, I don't know. Plus the annual appreciation, 27,250. I don't know how to incorporate this $4,000 of tax savings. I just explained to you, did I not? So you might as well add the $4,000 in on this line under tax savings at the end of the first year. That's what you got. We're going through that example. So let's add 4,000 of tax savings from that depreciation from the fourplex, plus 40,810. So that's almost 45,000. 45,000 divided into your total money you put into the deal. You're not paying 545,000. You're wise enough to get a loan, 25% down payment loan. So 45,000 of gross equity income with tax savings. The tax savings for my calculation is 4,000. You know what? This is not right. So 4810 plus 4,000 tax savings equals 45,000. 45,000 divided by your down payment. Let's do a calculation on my. Doesn't point to my madness. So $45,000 divided by $147,000 of your down payment money equals 30% total return instead of 28%. The 28% does not factor in the $4,000 tax savings. I just added the pure $4,000 tax savings directly into your pocket. So equals 30%. 30% total return on your investment at the end of the first year alone only. How cool is that? That is the power of the income property. You get annual net cash flow, annual projected appreciation, because your appreciation is calculated from the total purchase price, even though you didn't pay the total purchase price money. You only pay $147,000. That's the power of leverage. The power, amazing, the power of getting an investment loan, OPM, other people's money. You only put of your own money $147K to buy a $540,000 property. No other asset class can allow you to leverage in a way. When you have the ability to leverage, is it not your returns are exponentially higher than a asset class that have no leverage, like a regular stocks and bonds and mutual funds and crypto and Bitcoin or bonds or whatever out there? You have to buy dollar for mutual funds. You have to buy dollar for dollar. So you're not getting the return. That's why I said what I said. An income property, whether it's a single family residential home income property or duplex or triplex or 10 unit or 7 unit, is a multi-dimensional asset class. It gives you 5 components of earnings, whereas a stocks and bonds and mutual fund will give you only a handful of dimensions. That is the beauty, historical beauty. Plus, again, income property is what the world's most tax favor asset class. I just clearly explained that to you. Do you understand? Just at the end of the first year. That is absolutely mind-boggling. If you invest for the long term, which you should on any income property, what about the second, third, and fourth, and fifth year, sixth, and seventh year? That's even higher. That's even higher than 30%. What other investment will give you 30% when you factor in all these multi-dimensions of return, including the great tax benefit? Hopefully that helps you. So this is your Schedule E, supplemental income schedule. I just plug the number from the pro forma on the fourplex. Annual net income, $64,800, minus all the expenses, which I plug from the pro forma, which is right here, very, very simple. Regular deductions. Then the $15,854, where this number came from. I just show you the detail of the calculation. So this is a paper loss. At the end of the day, you have a total of $76,722 as total expenses. And your gross rent is $64,800. So in reality, you are making real money in terms of cash flow and other appreciation, whatever, which is not shown on the tax return. In reality, you're making money, but on paper, you lost money. And the money you lost can offset against your W-2 income if you make less than 100 grand AGI per this explanation. 64,800 gross rent for the year on this fourplex minus 76,722 because 15,854 is the paper loss. Paper loss, phantom loss. 36,000 minus 64,800 equals 11,922. This is a passive loss for that tax year, assuming you only own this one fourplex. So this 11,922 of passive losses can offset against your W-2 income if you make 100 grand, because you are allowed up to $25,000 of passive losses limitation based on this active participant rule. Does that make sense? I just show you the real basic rule. If you make more than 100 grand and less than 150,000, which I already showed you earlier example, you have a phase out, 50 cents to $1 phase out as your income goes higher. But when you reach the maximum of $150,000 AGI, adjusted gross income, all this, let's say in this example, you made more than 150 grand. The rule, the passive loss limitation rule, indicates that this so-called 11,922, if you made more than 150 grand, you cannot offset against your W-2 income. This 11,922 will be suspended indefinitely to the future tax year to offset against any potential passive income from your other, presumably from your other rental property. So ideally, if you have a cash flow property, another 1 or 2 or 3 properties showing passive income higher than passive losses on a subsequent year, this 11,922 can offset against the passive income for other passive activity rules. So when this suspended or passive losses cannot be deducted on the current year because you made more than 150K, so ideally you want everything to be deducted maximum on the current year, because I just told you, right? The future dollar in the future is worth a lot less than it is now due to inflation and the cost of living, the whole economic theory behind that. But those suspended passive losses into the future years, it is a future economic benefit. It still behooves you regardless of income. You make income however you make those income. The more income you make, the better. Don't say, oh, since Mr. Yi told me I get more passive losses if I make 100 grand, let's find a job that I can make less money instead of $150,000 I make right now. Now, that doesn't make sense. Your goal is to make as much money as possible from your W-2 income so you have money to put down payment to buy more rental properties. It is what it is. Your income is what it is at this current situation based on your career, based on your age, based on your occupation. The pro forma I just discussed on the fourplex show the vacancy factor. Let me go over the pro forma to see whether I incorporate maintenance issues. No, I did not address any maintenance issues as at least the first year because this is a new construction. That's the reason. But I did address the vacancy rate of 3%, at least that. When you buy new construction property, you have a appliance warranty, first year warranty, on the appliances and those kind of things. You have a 5-year warranty on something else. Then you have a 10-year warranty on a roof. So that's the value of a new construction. It's just that the maintenance issue is pretty minimal compared to a property that are much older, regardless of how much repair has been done on an older property, 30, 40, 50-year-old. You can have a lot more maintenance issues than a brand new house. That's the value of buying new construction, which I wholeheartedly recommend for you guys, if you can do it, if you can find those kind of deals. Of course, I have them available.